I'm very excited to have someone that's going to talk something different, something that we haven't had on the BLG experts before. And it's really a topic that's close to my heart. I think around 2% of the population has a financial planner. And I think, you know, the great businesses that we're building and also the money that we've, you know, created in our ex-career roles, it's really important to have those, have that money and use it wisely. And that's why we've brought on Paul today. And Paul is a financial planner. He's going to talk more about what he does. But I think it's really important when you're growing your business is to make sure that you're investing your money wisely, and also that you're then got enough money to give back, which really follows our build, live, give principles. So what I'll do now is hand over to you, Paul.
Thanks very much, Paul. Thanks very much for having me on. It's I've not done a Facebook webinar like this before, so I'm very excited and wonderful to be talking to the BLG community. So much appreciated. So look, what I'm going to be speaking on today, as you can see on the screen there, is financial tips and traps for people who have moved from being an employee to self-employed. I guess the presentation, I'm assuming within the BLG community that most people are already self-employed, but certainly if there's people watching this or listening to this that are still an employee, then there'll be plenty of relevance there for you as well. And we've got a few different tips in there for you, and there's one in particular that I'd be very surprised if you'd come across before. So I hope I can give you a bit of a surprise in there as well. General advice warning, I know it's a bit dry, but we've got to do these things. Obviously, keep in mind the information we're providing today is general. Your circumstances are unique and specific to you. So please, do get advice that's customised for you rather than necessarily jumping into the general information that we're giving today. Useful though, I hope it is. Just briefly, a little bit about me. Obviously in the BLG community, we're ex-corporate people, and that certainly applies to me too. So I'm ex-CBA. I was there for 16 years in a variety of different roles, but the last 7 of those as a financial planner. In 2006, I just reached the point where I wasn't comfortable in that environment anymore. I love financial planning, and obviously thus I'm still in it. I very much enjoy it, but just being within a bank where it was very much about product sales, I just got to the point where I couldn't stomach that any longer. So in 2006, I left the CBA and became self-employed and started my own practice. And obviously, 11 years have passed since, and a lot of evolution. This GFC was an interesting period in our business. I was able to purchase a business from a retiring planner at one point. I sold a bit of that, grown a great team, lots of interesting stuff along the way. The business now is travelling very well. We've got good momentum, and I was pleased just in the last fortnight, actually, just in terms of a bit of validation. I was advised I've been nominated as one of 3 finalists for the Certified Financial Planner of the Year with the Financial Planning Association, which is the peak body for our profession. So find out about that at the end of the month, and of course have the fingers crossed. But even if I don't win, just to be nominated as one of the top 3 in the country is just great validation that what we're doing is being recognised by others, and that was a great honour. I think the reason that we're seeing those sort of accolades is because we have had a real rethink about what we do with in respect to financial planning and what financial planning is, and so some of the discussion points today, I guess, are a reflection of that, I hope. Traditionally, financial planning is focused around, there's a lot of product focus and also very focused on retirement and I guess dealing with people perhaps a couple of years out, whereas I guess the people that we've found that we can have the greatest positive impact are people seeking choices in life, and that might be a career change or starting a business, semi-retirement, early retirement, very much in line, I would imagine, with a lot of people in the BLG community. We work best with people that have some ambition, they've got a goal or a dream, and they want to work with someone to help them get there. And the term we've put around that is financial autonomy. So we've launched a plan specifically about that, and I'll talk about that a little bit more at the end of the presentation. But yeah, that's I guess that's just in brief what we're all about. But let's jump into the meat of the presentation, which is about the challenges for people who have moved into self-employment. And I guess just as a bit of an overarching view of that, there's the two here that I've identified. Key person dependency, I think, is a really big issue, and overwhelm. Now, obviously, there are other challenges for self-employed people, you know, trying to do everything yourself and just all the challenges of running a business, but that's the sort of stuff that Paul and BLG assist you with. I'm here to talk about the financial type issues. So I'm just going to narrow down to these couple of issues. And even having said that, I'm going to mainly focus on the top one there, key person dependency. On the overwhelm challenge, I guess another way to frame that is it's a procrastination problem. And that's something that doesn't get talked about a lot, but is a really, really big problem when it comes to creating wealth. And that's largely because when it comes to creating wealth, compounding, whilst compounding seems like a very dull subject, it's extremely impactful. And I guess we see that most obviously in superannuation. You leave it there a long time. It doesn't seem to do much for a long time, but in the latter years, because your balance gets bigger, the impact of compounding is really meaningful. And so the cost of procrastinating is really significant. So, you know, that second dot point there, overwhelm is a challenge, which is, you know, I've just got so much on my plate and I don't know where to turn and it's all just too hard, so therefore I'll do nothing, right? Well, I mean, that's procrastination, and just be aware that that's expensive. And just to illustrate that, there's a client I'm working with right at the moment. He's Sydney-based, and about 8 years ago, he was in a position where he could have bought a property in Sydney. He had about 100,000 in the bank, had a good wage, so he was in a position to fund a mortgage. And but he procrastinated, right? He just couldn't quite pull the trigger. He then, for his work, got posted overseas, and he spent most of the last 8 years overseas in a couple of different places. And now he's back in Sydney. Now, he still has that 100,000 in the bank, and of course, with interest rates being practically zero, it's still about 100,000. But as we would all know, Sydney prices, as Melbourne and most of the country, but particularly Sydney and Melbourne, property prices have gone silly, right? And so he's really priced out now. Now, had he not procrastinated 8 years ago, you know, the $100,000, of course, the property over that period, depends where he was, but let's say it would have doubled. That's not an unrealistic expectation with what we've seen recently. But of course, he would have been leveraged. So actually his 100,000 might have been worth 300,000 or 400,000 now. So it's just a real illustration of the cost of not addressing that second challenge there, that overwhelm, that procrastination challenge. So as I say, the tips and things that I'm going to delve into, don't touch that one so much, but I just really wanted to highlight to people that is a challenge that a lot of people face. So if it's something you're facing, you're certainly not alone. But recognise, you know, try and take action. Anyway, let's jump.
Paul.
Yes.
Sorry, Paul. Just quickly on that. I totally agree. I think the stat we said prior to the call is about 2% of people have a financial planner, and if I look at most of our community, they surround themselves with great people. So they'll surround themselves with a marketing agency. They'll have a VA. They'll have a good doctor. They'll have an accountant, etc. But obviously that financial planning one is often missing. And I think you sort of, you know, summed up the value of getting it. When someone finally starts working with someone like yourself, what's the obvious realization they get to? What creates someone falling in that 2% category versus the 98?
Look, I think a lot of it is about getting a strategy in place. You know, we start with what are your goals and objectives, and do quite a bit of work on trying to get detailed there. So then we've developed strategies that flow from, you know, achieving those goals and objectives. And, you know, we're catching up at least once a year. There's usually communication throughout the year, but ensuring that we're actually making progress, you know, and as I say, not putting things off. I mean, the time impact is really meaningful. So the sooner you get started, you say, right, this is where we're trying to get to, and then we can develop some strategies and actually that's in one of the tips. I'll try not to jump ahead, but, you know, in terms of putting your cash flow to work and actually making the most of that, having a strategy, I suppose, identifying your goals, having a strategy, and then working to that strategy and checking in regularly. You know, life changes happen, but sticking to a plan. I think that's where the value comes about.
Yeah. So what I'm hearing from you is it's nothing majorly different. It's just the switch of whether I'm doing it or not. So I think, the great news is for anyone rewatching this that, if you haven't got a financial planner, that's fine. What does the Chinese proverb, I think, the best time to plant a tree was 20 years ago. The second best time is today. So I think, listen to what Paul's saying. And if you haven't got a financial planner, I highly recommend it because it really does help with that build and give. So I will, hand back over to you, Paul.
Beauty. Thanks for that, Paul. Spot on. All right. So let's jump into tip number 1, safety net. Now, back in the corporate world, you would have had sick leave, and there's a good chance you probably had some annual leave up your sleeve and maybe even some long service leave up your sleeve. So you had a bit of a safety net there that if, something went awry and, something nasty, a cancer or a heart attack or something, a serious illness, you knew you had something under there that would look after you. Right? But now that you're self-employed, that's gone. So you need to think about how you're going to solve for that. Now, most people, and I'm hoping within the BLG community, most people will go, that's okay because I've got some sort of income protection, right? And if you don't, we'll jump on it. But I'm going to make the assumption that most people in the BLG community, you're all smart people, you're going to have thought of that already, right? But here's the thing. With income protection, there's 2 varieties. There's agreed value, but there's another one called indemnity. Now, if you've got standalone income protection, about 30 to 40% of those policies will be indemnity style policies. But more particularly, if your income protection is through your super, which is very common, in super it'll usually be called salary continuance. Now, if that's your current solution, that will be 100% indemnity because the superannuation legislations insist that it be an indemnity policy. Now, the significance of indemnity is this. If let's say in your corporate job, you were on $200,000 a year, right? And therefore your salary continuance, your income protection benefit will be $12,500 in all likelihood, 3/4 of what you used to earn. So you'll get your superannuation statement. It says you've got salary continuance for $12,500 a month, and that gives you a lot of comfort. Beautiful, something goes wrong, I know I've got that. But it's quite misleading because in fact, what that's saying is $12,500 is the maximum benefit you will get. In fact, what we'll pay is 3/4 of whatever you were earning just before you become unable to work. Now, some insurance companies do that a bit different. Sometimes they might say last financial year, right? But it's recent. So if you've left the corporate world and moved to self-employment, and particularly in the first 2 or 3 years, there's a very good chance that your income will be less than it used to be back in your corporate role, right? You're building up a business, that's going to take some time. Also, you've got expenses perhaps in the business, marketing expenses, fit out costs, whatever. It's likely that on your tax return, your income is going to be less. Even just you might have a family trust and you might be distributing that to a few people as well. Now, there is some ability sometimes to add a bit back there, but nevertheless, there's a good likelihood that your income's less. And if that's the case, they will adjust the benefit down, right? So you are paying a premium to have this coverage up to $12,500, but it may well be an illusion. It could be that when you go to claim, they say, okay, show us what you've earned the last 12 months. You show instead of 200,000, perhaps you show 50,000 or something. So then, all right, well, the monthly benefit we're going to give you is 1/4 of what you had expected. So there is agreed value income protection, all right? If you're still in the corporate world, and I'm assuming that's not many people, but perhaps some, then it might be wise to get your income protection before you even leave and get an agreed value policy. Because then, even if you subsequently become self-employed and your income reduces, it doesn't matter because you've got agreed value and it's locked in at the time that you obtain that cover. If you're already in self-employment, okay, maybe that option's not there. But speak to someone, hopefully us, but whoever you think can help, speak to someone about getting a fit for purpose policy and don't waste your money on a policy that actually, if you go to claim, will give you a fraction of what you expect. All right. So that's my number 1 tip. Okay. You need a safety net. Income protection is your primary way to do that. But a lot of people think they're right and it's actually not fit for purpose. So please avoid that trap.
Yeah, Paul, just a couple of quick questions on that. So when you mentioned the income, exactly what do you mean by income? Is it net profit? Is it distribution of income? Like,
well, think about on your personal tax return, what would it say your income is?
right.
That's what they're looking for.
Okay. Yeah. And you did right. Like most of us either reinvest, we distribute it, so it's very low. I think the other point is, when I've looked at the fine print, is the time that it's paid. So for some policies, it's like 2 or 3 months, and normally you need it straight away. So sometimes a business having no income for 3 months, and certainly an early stage, can be crippling. So I think it's also the time that you get it can be a key thing to look at.
You're spot on there, and there's 2 elements to that. So what you're referring to there is the waiting period, and yeah, you're right. Particularly through super, it's usually 60 or 90 days, whereas standalone you typically have that as 30, but it's possible to even have it as a 14-day waiting period. The other slight angle on that too is the length of time it pays. So a lot of policies will stop after 2 years. Better quality policies will go all the way out to age 65. So yeah, look, that's the sort of detail that get a bit of advice on it. You know, get a solution that's actually fit for purpose. Just the other one, just before we move on, just on safety net too, there is some other insurance that you might want to consider, which is called trauma insurance, and it's one that, you know, not a lot of people come across. Unfortunately, different insurance companies call it different things, but essentially it just has a list of medical conditions. It's usually about 40. Statistically, far and away, the most likely will be malignant cancer or a heart attack, right? You choose an amount of benefit, so it might be 100,000 or 200,000 most commonly. And if you suffer one of those conditions, but survive, right? So you've got life insurance. That's if you pass away. This is if you suffer one of these conditions, you know, and live, then bang, here's your check for whatever amount you chose. It might be $200,000, for instance. That can be very helpful for a self-employed person. Trauma cover is not very expensive typically. And just to here's a lump sum, use it however you wish. So depending on your business, you know, you might be able to get someone to assist, or maybe just the business, you know, stops for a period. You might have out-of-pocket medicals. I've had some people use their trauma, you know, they get through chemo and then they want to go on a bit of a family holiday or something. So that's another one just you might not have come across, but particularly for self-employed people, it could just be a nice one to add, and it's one that's not especially expensive. So just to sort of make you aware that that's there. All right, let's have a look at the second one now. So superannuation, and the point there is be interested, right? I know in the corporate world, really, you don't have to take a lot of interest in your super if you don't choose to. I mean, your employer's going to contribute whether you like it or not. That's the law. Hopefully by default, it's put you into some sort of growth or regressive option, something that's suitable for a long-term time horizon. And if you chose, and a lot of people do choose, you could really, you know, not pay your super much attention. And certainly I've come across people who, you know, they bring in the envelope and they haven't even opened the envelope to see what's inside. That's how sort of disengaged they are with their super. But as a self-employed person, I really encourage you to be engaged, to take an interest in your super. For one, obviously, contributions aren't going to happen automatically. And contributions are, well, obviously, you need to build up the balance. There needs to be contributions that occur. But also, you know, in days gone by, there was perhaps some ability to, you know, ignore super for 5 or 10 years maybe, and then that's okay, because then later in life, I'm going to go hell for leather on my super contributions. Made that really hard now. You know, your contribution caps is $25,000 a year. That's for tax deductible type contributions, the type that most people would make. 25,000 is as much as you can get in. So if you don't make any contributions to super for the next 5 or 10 years because you're focused on building up your business, your ability to then try and make that up later in life is going to be really difficult. So for one, take an interest in super, make some contributions. You don't have to, you know, if cash flow doesn't permit you contributing the full 25, that's fine, but try and do something and get something in and use up your you know, at least a portion of your caps each year. The other aspect about your super though is, well, one other aspect is that there could be, as a self-employed person, the ability to move your superannuation into a self-managed super fund. And that could potentially, if you ran a business where you needed a premises, your self-managed super fund could potentially purchase the premises and your business lease that premise back off you. And the office that my staff work out of here, we've done exactly that. So my wife and I have a self-managed super fund. We've bought the premises and then we lease that, the business leases that off our self-managed super fund. And the reason that we did that primarily is because this was a brand new office. It was just an empty space. So fit out is expensive, right? And depending on your business, you may well see that as well. And as the tenant, it's a bit depressing to spend a whole lot of money on a fit out and think, well, 5 or 10 years down the track, hopefully the business grows, we outgrow this premises, we move on, and all that money we've just spent on fit out is left behind for the benefit of the landlord. By us, our self-managed super fund owning it, at least if we do outgrow these premises, we can lease it out to someone else, and hopefully, as the landlord, the rent reflects the fact that we've completed that fit out. It also does just give you, there's some other sort of flexibility type options there that can be attractive as well. Now, I wouldn't suggest that you have 100% of your super in a single, property asset. You definitely want diversification. So it's a matter of, whether you can make that work within the budget and within what you've got to work with there. But certainly for some self-employed people, self-managed super could offer some advantages. Self-managed super isn't for everyone. It's a bit oversold, I think, at times, but it could be relevant. The other thing too to think about, I think a lot of people with the background that the BLG community would have quite possibly have shares in their previous employer. I mean, I was never at an executive level or anything like that, but nevertheless, I still had CBA shares when I left. And of course, people in more senior positions would have far more. Just think about with your super, say for instance, if you worked in a bank environment, right? The ASX 200, 40% of that is financial stocks. So if you have significant bank shares, for instance, in your personal name as a consequence of them being your previous employer, you probably don't want your super to just be in a standard Aussie share exposure because you're going to be massively overweight to that sector. And if, something troubling did happen in that sector, it's going to really impact on your wealth. So you want to be thinking about the asset allocation of your superannuation and how does that complement with your assets outside, and particularly personal shareholdings, and even more so if you've got quite a concentrated exposure as a consequence of receiving shares through your previous employer. So they're just a couple of issues in terms of your superannuation that I suggest you give a little bit of thought to. And the third tip I've got for you is about structures. Now, hopefully when you kicked off your business, you might have sat down with your accountant and talked about, you're going to be a sole trader here or a company, or how are you going to set that up? If you didn't do that, it's not too late. And even if you did, your business will evolve over time and you can always make changes. But give some thought to whether a discretionary family trust in particular might offer some value and some usefulness. And one strategy that we see some use for sometimes is let's say you have a business, it's grown a bit, and it's got to the point where actually the revenue that's generating is more than you need and your household needs on a day-to-day basis. So let's try and put some numbers to that, right? Let's say you've got a business that's throwing off $300,000 a year. And actually to run your household, you only need 150. So therefore there's 150 surplus to do wealth creation, to do other things with. If you've got the family trust that owns that, the family trust distributes that 150 out to your household, the most efficiently possible. Perhaps, husband and wife, something like that, maybe some adult kids if that was there. But the 150 surplus, you can send that to a bucket company. And that bucket company will pay company tax rate, 30%. And then that'll sit there. And within the bucket company, you can invest that money and do whatever you want to do. But the attraction is, fast forward, at some point into the future, maybe you've sold off the business or retired, or, it depends on what life brings. You can then pay that money back out of the company, out of the bucket company, and distribute that out, and that'll come out as a fully franked dividend, right? So depending on where you're at, if you're at a point, you might be in full retirement and in pension phase, in which case you've got from your super zero tax. So if you're distributing out of that bucket company and you're getting a 30% tax credit with that, there's a high chance you'll pay no tax at all on that money coming out, and maybe even get a refund because the 30% might be more than you need. It'll depend on your circumstance at the time, but it's a great way to get a more tax efficient outcome than if you had that initial 300,000, if you had taken that all at the time, you would have paid, or some of that would have been getting into top marginal tax rate or very close. So just ensure as a self-employed person that you're making the best advantage of the structures that are available to you. And the most likely one is to have a discretionary family trust that you can then send income and potentially even capital gains, which is not directly relevant to your business, but it is relevant to your wealth creation. You can sort of stream the income to the most efficient source. And we're not talking about avoiding tax. Obviously, tax is important. That's how we have hospitals and roads in a great society. But that doesn't mean that you necessarily need to pay more than you should.
Yeah, so Paul, look, some great points there. I know some people say that it's going to be just more headaches at tax time when, you know, I've got to do all this compliance work and I've got to pay additional fees to my accountant to keep it going. What are you to say to some of those objections that you've probably heard in the past?
Look, it's right. Look, there is more expense yet. The accountant's got to do the return for the trust, but I mean, that's just a matter of doing your numbers. You know, yeah, you're not going to set up a trust if your business is throwing off 50 grand a year, but if your business is throwing off 300, 400, 500,000 a year or more, you know, the extra $1,000 it costs you in accounting fees is going to be insignificant. So, you know, it's horses for courses, but certainly don't do it if it's not cost effective to do it. But I would have thought for most people, once your business is up and running and generating a sustainable income, it's very likely that a family trust is going to be a sensible structure to sort of hold your business and direct income through. All right. Well, we're at the tail end of the presentation, so I'll just quickly talk a little bit about what we do. I know, you know, mainly this is about sharing expertise, but hopefully you'll just indulge me for a little bit. So as I mentioned at the start, we've got a program called Financial Autonomy that's for people that are seeking greater control in their life and greater flexibility. And I would expect that would, you know, resonate strongly with the BLG community. So financial autonomy there, it's about gaining choice. Of course, how can it help? You know, developing and deploying financial strategies to get you towards your goals. So we've developed that thinking about what are the pain points, why aren't people achieving financial autonomy, you know, what's the obstacles and how can we solve for those. So one of those that we hear a lot is around cash flow, and this was to a point that Paul raised earlier, and I guess it also hits on that key person dependency as well. So people are telling us that, you know, they're getting good cash flow, but somehow or other that's not translating into wealth, and they can't quite grasp why that's not translating into wealth. So one of the solutions we've got around that is some software that we use called My Prosperity for our clients. Anyone who's used Xero, I haven't used Mile, but I suspect it's similar, but certainly like Xero, it's quite similar. Xero's for your business, My Prosperity's for you as an individual. An app on your phone, everything links up to it, all your transactions flow through to it. You teach it, you know, if it says Coles, well, that goes to groceries, and if it says BP or Shell, that goes to fuel. And then you can set up savings goals, and it'll say, right, you're 47% of the way there or whatever. It gives you a really good insight into your cash flow and enables you to really move forward in a wealth creation sense.
Paul, sorry,
yes.
Paul, quickly back on that one, is that a combination of business and personal, or is it more directed towards personal?
It's intended for personal. Yeah. It's good. It gives you, you know, it even picks up live valuations on your property, so it gives you net wealth position. And in fact, the CEO of My Prosperity now is the ex-CEO of Xero. So I know a lot of people use Xero. I certainly do. It gives you a good feel for it. Another, I guess, pain point for people is not having a plan. And again, this is a little bit what Paul and I discussed earlier. So of course we have a solution for that. And you can see there, you know, establishing your goals, which is the foundation, I guess. Then we do a whole lot of research around fit for purpose, you know, insurances, estate planning, your superannuation, all those sort of things, even potentially looking at your mortgages. You know, are you getting the best deal you could do there? Develop a strategy and then work through that, get that implemented. And the final, I guess, pain point, the final barrier that we've come across is not having any support. I guess sometimes, you know, I've come across people, for instance, who have had a self-managed super fund established by their accountant, that they come in to see us 3 years later and there's no money in the self-managed super fund because they didn't get any support in actually rolling over the funds from their old super fund. So, you know, we rather than it as a one-off project, we view it as a 6-month engagement. So when you take us on under the Financial Autonomy Program, it's a 6-month engagement, and I'll take you through a little bit what that means. Of course, beyond that 6 months, most clients choose to work with us beyond that, but that's optional. Just in terms of the framework, an initial discovery meeting, which is typically by webcam like we're doing today, we take that away, do the research as I mentioned earlier, develop a strategy, then we get back together, have a second meeting where we present that to you, answer any questions, make some adjustments, and then we do all the implementation. Of course, there's some documents that will need signatures and things, but we manage that for you. And then importantly, we refine it. So from first meeting to implementation is typically 3 to 4 months. The last couple of months is just about refining it, because people are estimating, look, this is what I think my savings capacity is, but until we run with the strategy, they're never quite sure. So we allow some ability there to move that around. I mentioned at the bottom there, just the cost. It'll probably go up next year, but we're trying to position it as something that's very affordable and approachable for most people. So there's 990 initially, and then 6 monthly instalments. In terms of just a special offer for BLG, and this is something that I haven't done in the past, but I'm just really confident in terms of the BLG community that this is a great fit, and I'm really grateful for Paul for inviting me on and to speak. And so I just put it out there that, look, anyone in the BLG community who would like to take us on and take on this financial autonomy program, if at the conclusion of the 6-month program you feel that you're in no better position than you were when you started, then I'll provide a money back guarantee, 100% refund, right? I'm just totally confident that if you work with us and we go through that 6-month program, we've done it enough with clients now that your position will be improved. So if you're in any doubt, and as I say, if you get to that end of that 6 months and you don't feel you're better off, let me know, 100% refund, no problem. So just to wrap up, the 3 tips there, the safety net, and particularly have a good look at your income protection, or in brackets salary continuance if it's through super. Superannuation, please take an interest. It's a really significant asset. I know it's easy to ignore, but in terms of your wealth and your financial position, really, really important. And structures, if you haven't already had a good discussion about structures and really making the most of the opportunities there, I really encourage you to do so. As a self-employed person, you're in a position to use those structures. You weren't when you're an employee, but they're available to you now as a self-employed person, so use them. And that's me, Paul. I hope I've done all right from a time point of view. There's all my contact details. Hit me up on LinkedIn. Of course, I touched on earlier, we've got a podcast, Financial Autonomy Podcast. So I'd love you to, give a listen there and let us know what you think. We've got some interviews coming out there. We've got some really good content coming up in the coming weeks and months. So subscribe if that's, if that's your thing. And of course, there's a Financial Autonomy website as well. Reach out. We'd love to hear from you. Love any sort of feedback. Over to you, Paul.
Yeah, great. Thanks, Paul. And I've just got a couple of questions that when the topic came up, some people in the BLG club and also in the community had. So I've just got 3 that I'd love to ask you. So one is around sort of it's nearly the elephant in the room, but when people think of financial planners, they think financial planners, normally the licensor or the key person behind it is a bank, and they normally peddle their own material. So when people say that, I know that a lot has changed in the industry. Well, what's your view on people say, well, I'm not going to go to a financial planner because they just peddle what the banks are trying to sell and they're not looking after me?
Wonderful. Thank you so much for asking that question. So they are often dead right, okay? It doesn't apply to us, however, because myself and a colleague have applied direct to ASIC and we hold our own license. So we don't have any tie to any product manufacturer. You are right. Most financial planners are either, or a lot, I should say, some are employed directly by banks, but there are a lot of businesses that will be an authorised representative of some other entity, and typically that entity will either be owned by AMP or one of the 4 banks. It is a significant problem and something that whenever I get an opportunity, I try and advocate for. In my view, advice and product manufacturing should be totally separate, but that's not the case at the moment. But nevertheless, for my business, I can absolutely give people assurance that, yes, we have I'm a responsible manager, director ASIC. I have that with a business partner, and we have our own license, and there's no interference from any product manufacturers.
Okay, fantastic. And look, I concur with that. Is just where you can seek independence. I've got a financial planner we've had for it's a good 15 years now, but that was really a key point of why I went with that individual, because of what you just said, Paul. The second question is really topical. It's hot at the moment. It's sort of linked to cryptocurrency and ICOs, and there's a lot of stuff in this space. We had a brilliant webinar by Jason Atkins and Anders Elm the other day, who are two members.
Yes.
Two members that have got lots of knowledge in this space, and it was brilliant for our community to understand it better. And sort of the question is how much should someone invest in what could be perceived as a risky asset class? How much of their personal wealth should they be putting at risk in something like that? So I'd love to get your view on that question.
Yeah, I mean, look, it's a fascinating space, and certainly the growth there has been extraordinary. I guess, it is high risk. There's no question, right? So I guess, to some extent, the simple answer is, well, you could put as much there as you can afford to lose, right? And I know that's a bit cheeky, but, that's really where we're at. I mean, look, it's highly speculative. So by all means, have a crack if you'd like to have a crack, but, you wouldn't bet the house on it, would you? It does. It's just a fascinating area. I've certainly, like you, I've been reading a lot about it, and the parallels to gold, I guess, as an alternative holding of wealth, and particularly for people in Asian countries, of course, who went through the Asian financial crisis. There is some good rationale. I mean, years ago, I just, when it first came out, I thought, well, surely the only people in there are criminals, but it's certainly not the case anymore. And it is a fascinating area. But sorry, to answer your question, look, recognise, look, it's a high risk, highly speculative, have a crack, but, I mean, for me, geez, I wouldn't even come close to, 1% of my assets going in something like that. I mean, it really is, it's punting money, right? If you are, I don't know, if you're the sort of person that occasionally buys a speculative, mining stock or something like that, well, whatever your normal budget is for that, you could do much the same with Bitcoin, would be my suggestion.
Yeah, look, I think that's great. And I know for me, I always look at around 5% of our total wealth is invested in more speculative. So I'm an angel investor, so I do some investments through that. And now I'm also looking to have a selection of coin, so to speak, across multiple, because I think one of them will definitely make it. So, so great advice. The last question is, I know often people, it's important to have someone within Australia to deal with Australian nuances, and I get that. But I know some people often say, well, I can't find someone in my local area. I just wanted to get your views on, does someone have to be in the local area, or can you work with a financial planner no matter where they are in Australia?
Yeah, that's a great question, and I would agree. Historically, you try to find someone local. It's an interesting thing. I mean, look, I'm in Essendon in Melbourne. So for people that are local, we've got an office, you're very welcome to come in. But what I'm finding is, even for people that are relatively local, once we do a web meeting or two, they're not coming in anymore. I mean, traffic congestion is horrendous any time of the day, it seems. So why would you fight the traffic when you could have a web conference? I mean, there's no question that a phone call, sometimes I have to do meetings via phone, that is definitely inferior to a face-to-face meeting, no question. But a web conference where you can see someone's face, you can interact, we can share screens, sometimes have clients, hold up documents so I can see them. Web conferences are sensational, and when you're doing it via web conference, it really makes no difference if the person is 20 minutes up the road or hours away. I mean, I've got clients, as I said, I'm in Melbourne, working with someone at the moment in Sydney. We've got clients up in Byron Bay and all up the coast. So, yeah, look, it's just, I understand that historical train of thought, but I really encourage you to just move past it, because web conferencing is so efficient these days that you're not missing out.
Yeah, and it's funny, we've got a launch event coming up on the 16th of November, and I went to invite people and realised that I've actually got few people in Melbourne itself.
Right.
Most people are spread, throughout the world, and I think that's the brilliant part of it. And also, I think by default, sometimes when you get in a face-to-face meeting, you can just chew through time, and time's the greatest asset that we've all got, certainly small business people. So I think having the quality of, like you said, not having the travel time and being able to use that time, have little half an hour, 45-minute meetings like we have today and get a lot of value. The other quick tip I'll have is for anyone rewatching this, certainly if they're hearing me talk, is, speed it up. So I watch all my videos at 2 times speed, sometimes at 3. And,
Nice.
I can get through something like this in, 15 minutes where, normally at normal speed it takes 45. You can't ask people to talk 3 times faster in a face-to-face meeting. So, that's something that I do. And I wish they had that ability to free-to-air TV, that you can speed it up as well. But anyway, enough on that. But look, Paul, brilliant having you on. I think it's really important for all of us in the Build, Live, Give journey that we really look at that live component, and we look at how we can compound our money, as you mentioned, and also the more we do that, the better we can actually give back and help others. So I think it's a really important thing. So the offer will be in the Facebook group that you can go and see that from Paul, which is a very kind offer. And I know Paul's in the BLG community as well. So if you want to ask him a question, etc., just hit him up in our Facebook group, and Paul would be more than happy to help you out. So thanks a lot, Paul, for coming on today and sharing your expertise. We really appreciate it.
Wonderful. Thanks very much for having me on. And yes, thanks everyone for having a look.
Great. Thanks, Paul.
Bye-bye.